We were talking about, this was the phase we were talking about here. This was live. And the reason why this was exciting was because the market maker didn't achieve what they wanted at the time, and it was one of those ones that, again, people were able to at least follow and track during that period. The market maker had been trying to get, we're trying to discover prices down into this lower level here. They were trying to discover this trade here. And you're not going to pick up on stuff on this from the first time you hear about it, but it slowly will start to build as a process. And what I'm hoping to do is I'm going to get these phases of the market maker dealing book coded so that it's going to be live and visible either in TradingView or on the website, or both, so that you can actually see where the market makers are in certain markets at certain times. So this is the goal that we're working on just now because it's the cleanest, easiest book to read. There's several words that we use as market makers to try and understand the phases that we're in. The words would be things like aggregation, the things like mitigation, accumulation, distribution. Pretty much any word that ends in an N is a word that we're going to use. And the only other word would be the withdrawal of liquidity phase. The mitigation is obviously when they're in a wrong trade and they're trying to get away from that trade. Well, when a wrong trade, they're in a trade that they didn't expect necessarily to be in. Usually it follows a withdrawal of liquidity phase, because obviously a withdrawal of liquidity phase means that they are now driving the price where the bias is now bullish and they haven't been able to aggregate at an earlier stage. Now, what is aggregation? Aggregation is a build of positions, perhaps to get net long for a break higher or net short for a break lower, so you can sell to buyers or buy from sellers. Or it might simply be a martingale type strategy, taking the price higher to close off the buyers, selling a lot of business up there to bring up the mitigation point in a trade. We saw that exact example today. We called it live in the room today, and we were able to discuss exactly what was happening. It was this aggregation here. So what happened was that the market makers were trying to get business to come down into the bottom edges, and then a commercial buyer came in here and surprised the market makers. Okay, so a commercial buyer came in here and surprised the market makers, and that's obviously something that sometimes happens. The market makers got surprised by a commercial buyer coming in at higher prices, not lower, but a commercial crossed the spread here. And obviously at that stage, the market maker's going, okay, wow, I wasn't expecting that. And now the market makers ended up, because the market maker at that stage was trying to squeeze the price down, so the market maker sold that candle. Well, that's interesting, isn't it? The market maker sold that candle. So in other words, they took this business on the books. Now you can see that they got a pin rejection here for almost the same volume. So they actually managed to mitigate an awful lot of that business in the first candle following, the next 60 seconds it followed. But obviously they didn't mitigate all of the business, and they were still in a short position when the market started to break. So the market maker withdrew liquidity. Now, when the market maker withdrew liquidity, you can see where they withdrew liquidity to. It was simply what we would call a market measure. So they withdrew the liquidity to a market measure, and then they did what's called an aggregation. Now, this happens at measured moves. An aggregation happens at measured moves, and an aggregation is simply a building of supply or a building of demand. They're building supply, they've withdrew liquidity, and now they're building supply again. What they're trying to do is they pull the price up to close off the buyers. They start selling aggressively off another key level, hoping this time to rotate the price back down again to mitigate the whole position. It's quite an easy price. And as it turned out, the mitigation was very, very easy indeed. They started to mitigate into this area here, and that was the mitigation. They made their profits. They were now flat the market, and they did some good business. The interesting thing that happened again was the market makers were very, very interested to see if the commercial appeared again here. We saw another kind of small-time commercial buyer trying again here. But what happened was the market makers started to aggregate this price. Now, what does that mean? Well, do we know it's definitely the market makers? Well, it's obviously aggregation is one of the challenges, because aggregation could be the market maker or the commercial, because somebody is just sitting on the offer. You know that commercials are passive sellers. Well, so are market makers. They're passive sellers. So these guys will be overlapping in terms of their order book. So we started to see an aggregation. We started to see, it doesn't necessarily mean that we're getting volume here, because the volume is dictated by the market buyers in this situation. And if the market buyers are not buying, aggregation doesn't necessarily mean big volume, it means big offers. And obviously, if they're starting to aggregate this, I think they're going to do a withdrawal of liquidity, because after aggregation, a lot of the times there is going to be a withdrawal of liquidity. Now, this aggregation had a mitigation, because obviously it was following a withdrawal of liquidity in the first place. This aggregation means that the market makers are actually trying to get net short on an uptick. Why are they trying to get net short? Because if you're clever as a market maker, you don't just always go for balanced books. You try and accumulate small positions. Now, their job is not to get net long or net short heavy and to run massive positions. But if they have a feeling that the market is going to drop, well, it would be kind of stupid of them not to try and aggregate. You know, if I've got the ability to have a big holding of longs when the market breaks north, well, I'm not taking on losses if the market breaks north. I'm just taking in profits. I'm selling my long position to buyers at higher prices, and that's something I can do beautifully. Once I've used up all my inventory, then I move into drawdown from that point onwards. So the later I can move into drawdown, the safer my trading is, surely. So it's in everybody's interest, in my interests, to try and aggregate into certain positions. And these aggregation points are areas that obviously are very, very, very good places to start thinking about. Now, we knew that there would be an aggregation here. That's why it became difficult, because it never aggregated at those lower prices. So the aggregation here was beautiful to the MIT, and then the aggregation here followed by the withdrawal of liquidity here was beautiful. So obviously that aggregation, when the market drops here, you're probably starting to move into drawdown from this point onwards here. It's the measured move, of course. And obviously the big volume comes in here as well. So the market maker is now detecting offers. So what's going to happen in that stage there is the market maker will add in offers behind the market, and we'll get a withdrawal of liquidity. They'll add in offers, pull away bids, and we get this withdrawal of liquidity. Add in offers, pull away bids. And that's what a withdrawal of liquidity is, right there. As the market moved forward, the market maker did a great bit of business here. I joined actually in with this trade here. I couldn't help myself. It was so good. So what happened was we got a new bottom edge here. Market makers are now bullish the market. Market makers are bullish the market, so they're trying to get long. So they got an aggregation right here. They managed to jam the price at this capper price level here at 99s, took the price down. We got an aggregation into the low here, which gave us a perfect excuse to buy into lots and lots of positions here. And then they were now trying to pull away the liquidity, and that pull away of liquidity, guys, was absolutely brutal. The traders did not know what hit them. Well, I did. It was a perfect market maker trade. Now, what are they doing just now? Well, they're trying to spoof the market lower. So what they're trying to do just now is they're spoofing the market lower to try and get the sellers to come back in at lower prices. They're trying to balance basically the last leg higher, because if this is a withdrawal of liquidity, the market maker aggregated this phase. Well, this candle here probably starts getting the market maker into drawdown. So now with this candle going higher, the market maker is moving into a drawdown phase. What happens next? Well, the market maker needs to mitigate. So from this candle here, the market maker needs to mitigate. So obviously you can see that the market maker spent a fair amount of time here mitigating some of that trade, making some nice money on these rotations. And they've done it again here, and they keep on doing it again at higher prices. Now the aggregation short hasn't taken place. Not surprising, the aggregation hasn't taken place, but what they are doing is they're trying to offer into the high price just now. So what they're trying to do here is they're adding some trade in here. They're adding some trade in here. Okay, so they're adding offers to basically try and spoof the price down. Okay, they're adding offers to try and spoof the price down a little bit here. And they're just trying to cause the buyers just to get that little bit exposed into those higher edges. And that's what we're trying to establish, is that little bit of exposure into those higher edges. And that's obviously going to open the door to absolute perfection. But it's obviously, it's not a sell trade as a net sell trade. The net sell trade is this buy trade here. That's the net. Sorry, that's when they got net short. Market makers got net long. And that was the perfect takeaway from that price just there. That was the perfect takeaway from price.